In today's video, I'm going to share with you this options risk calculator that I created. It's just a very basic calculator that's going to allow you to plan your risk reward on your options trades. As we know, it can be very difficult to manage risk when day trading options. So hopefully this will help you out. I'm going to break down exactly how I use this calculator on a trade that I took yesterday on NVIDIA and make it available to you guys down in the video description below. Hey guys, I'm Tex. If you're new here, I share my journey and experiences with trading and investing in the stock market. Really appreciate you watching. Let's get started. Okay, before we explain the calculator itself, let me just show you this trade that I took on NVIDIA, and this is a very straightforward trade. This is basically your classic double bottom setup, right? You have NVIDIA that actually opened up right here, rallied really good off the open and pulled all the way back down into the double bottom, dipped a little below but held, and then ended up rallying all the way back up to high of day. So I took this when I saw the double bottom hold and it reclaimed the 9-day. And basically I'm referring to the 9 EMA on the daily chart, which that fuchsia line right there is marking. Now that indicator does move in real time, so when I took this trade it was actually down around this area. So when I saw that the double bottom held and we reclaimed that 9-day, I decided to buy some 410 calls. Now as we know, when we're day trading options, we're always planning our trades, our risk and our reward off of the underlying chart, not the options chart. So in this particular example, my clear technical stop has to be low of day. It has to be the double bottom. So if NVIDIA comes back down and breaks that low, I have to take the trade off for a loss. But we may not know exactly what the premiums on those contracts are going to be if that happens, and that can be difficult because if we take too much size, not realizing how much risk we're actually putting on, we can end up losing more money than we're really comfortable with. So that's where this calculator is going to really come in handy. So I'm going to open this up, and again, the link will be in the description below. It's totally free to you guys. The way that you save this is you need to have a Google account. Again, that's also free. Pretty much everyone has one. Just make sure you're logged into your Google account and go to File, Make a Copy, and you can save it to your Google Drive, and it will then allow you to edit the spreadsheet. So we're only going to be inputting data into white fields on the spreadsheet. So you can see that we have 2 white fields here on the risk calculator. We have 1 on the profit calculator, and then we have several over here on this custom calculator. So let's start out with the risk calculator side. Okay, so here's your risk calculator. And what we need to do is we need to input the delta for the contracts that we're buying, and we need to input our stop loss that again is based off of the underlying chart. So yesterday, again, I bought here when the double bottom held and we reclaimed that 9-day. I bought 410 calls and my technical stop is going to be here. So when I bought those 410 calls, the delta was actually 61 cents. So I'm going to input 61 cents for the delta. And you'll notice when I input 61 cents for the delta on the risk calculator, it automatically puts that same number into the profit calculator because that's going to be used for calculating our reward on those same contracts that we're trading. So we only need to input the delta on the one side there. Now our stop loss on this trade, obviously this was going to be our technical stop. So from where I'm getting in the trade down to our stop loss, call it about $1.80 on the risk side. So we go back to our calculator and our stop loss needs to be $1.80. Okay. Now what that's going to tell me is basically the actual dollar risk that I'm putting on if NVIDIA doesn't hold this double bottom and I have to stop out. So let's say that I take 5 contracts, buying here, risking $1.80 per share on the underlying, then I'd be looking at losing $549. Now a word of caution, this calculator is only taking into account the delta, which is the change in price on the underlying basically. It is not taking into account time decay or implied volatility. Both of those will impact the premiums of the options contracts that you're trading, especially implied volatility. So sudden spikes in volatility can lead to larger losses and gains than what this calculator is going to show you. So just keep that in mind. If you have a sudden spike in volatility, the premiums are probably going to move a lot more than what the delta is showing you here. But for the most part, it's actually pretty darn accurate. And I'm going to show you a specific example on this trade of just how accurate it ended up being. So with that, I know okay, am I going to be comfortable with losing $549 if this trade doesn't work? Maybe I'm not. So what happens if I take 2 contracts? We're down to $219.60. So maybe that's a little bit better. So I know right away how many contracts I need to take in order to be mentally okay with that dollar amount if it comes down to being a losing trade. Okay, so that right there is incredibly helpful for you to plan your trades. Now we can do the same thing for our profit target. Let's say that we were actually maybe going to target high of day, but we're going to probably take profit into the VWAP. So we're looking at roughly about 3 points to the VWAP, and to high of day we're looking at about 6 points. Okay, so let's start with the VWAP. So our first profit target is 3 points away from where our entry point is. So with 2 contracts, we'd be looking at a $366 win, risking $219.60. With 5 contracts, we'd be looking at a $915 win, risking $549. So roughly 2 to 1, maybe not quite, but okay in terms of risk reward. I'd like to see better if we can. Up to high of day gives us a really good risk reward trade. So up to high of day again was $6 per share change. So we look at 2 contracts, that would have been a $732 winning trade versus our risk of $219.60. So right away we can actually put physical dollars on the trade and see exactly how much we would lose or make if the trade doesn't work or does work. So very, very helpful. Again, just be aware it is only being calculated off of delta, so spikes in volatility will result in different premiums most likely. Okay. Now what I did in order to show you how accurate this is I took a picture, and I'm sorry the quality of the picture isn't super great, but when I took this picture you can see that NVIDIA was trading at 417. Okay, so that was right up here. Let's go back to our charts. So that was right up here. 417 is here. Okay, so that was right about here. And it's a little above high day. It's pretty close. And we were looking at, a 6 point per share gain from our entry point. So we got in here. If we took it all the way up to high of day, that was a $6 per share change on NVIDIA's stock price. Okay, so let's go back to our picture here. Basically, what we can do to kind of verify this is we take the delta when we bought the contracts, which at the time was 61 cents, and we multiply that by the point share gain or loss on the underlying. So again, from where we got in up to high of day, that was $6 per share. So you can see that I took the delta of 0.61 and I multiplied it by $6 per share. And that basically gave me $3.66. So what this is telling me is how much the premiums have increased in value from where I bought them. Okay. Now I can take what I paid for the contracts, which at the time was $8.10, and I can add that change in the premium, which was $3.66, which then tells me that the premium should be about $11.76 when NVIDIA gets back up to high of day from where I bought them. And you can see with NVIDIA trading right there around $417, pretty close to high of day, the last price to come through was $11.65. So it's pretty darn accurate. Now, again, the spikes in volatility can impact how accurate the calculator will be, but also when you're trading close to expiration. So like on a Friday, the day of expiration contracts, the theta or the time decay can really melt down those premiums. So you might end up losing more than what just the delta is giving you. But it's a very generic calculator, as you can see. It is helpful, especially when you're learning how to position yourself for trades in terms of how much size to take, so that you're at least a little bit more aware of just how much dollar risk you're actually putting on for a particular trade, which is an absolute must, obviously, when we're talking about trading. And knowing that can make options a little bit daunting, especially for beginners, because it's hard to kind of calculate all that at one time. So hopefully this calculator will make it a little bit easier for you to do that kind of on the fly. I keep it open on my side monitor, so if I need to very quickly input the data to kind of compute it and just come up with a position sizing that I know I'm comfortable with, it's a great tool for that. So hopefully it helps you guys out. If you have any questions or comments, Be sure and leave those below. As always, I really appreciate you watching. Take care, guys. We'll catch you in the next one. See ya.